Hi everyone. Um, my name is Victorino, and today I'll be presenting my mind map and course structure of international finance coursework, primarily to better understand how international finance works in the bigger picture. And today I'll get you throughout all the presentation. To me, international finance primarily focus on studying how monetary interaction between one country and another works. It is primarily because there are so many multinational corporations trying to expand their reach to other geographies. And this presentation, we will focus on two things, primarily on how multinational corporations work and how they operate in other countries concerning currency exchange. Firstly, we're going to talk about global business operations or multinational corporations operations, specifically to identify how is usually a firm operates in multiple countries. And the second, we will take a look on the currency exchange concerning how it affects the operations of multinational corporates. So let's take a look on the global business operation first. International finance primarily study the behavior, scope, and concerns of multinational corporations, meaning studying how specifically a company can expand their reach and better capture customers beyond their host country. So let's take a look on the first branch, exactly on why even multinational corporations look to expand their reach. This is primarily driven by by two things. The first one is to capture higher revenue, and the second one is to decrease their costs. In this both contexts, it's usually there are three key drivers. The first one is comparative advantage, meaning if a company expand their operations to different country, uh, they can specifically choose based on what that specific country is is more efficient to produce something. So let's say if Apple want to better create their product in efficient manner, they would create a factory in the let's say in China to attain lower variable cost. The second is um, imperfect market, meaning that meaning that companies are expanding because they see that barrier of entry in other countries is much more thinner compared to their host country. And the third is because of product life cycle. So this is primarily because they see there are a lot of opportunities where a product is still new and has a lot of early adopters in other countries. On the second, let's take a look on how MNC operates. Primarily, we will take a look on two things. The first one is the fundamental of corporate finance of a domestic firm, and then we're going to study the second thing, which is corporate finance of an MNC. Both domestic and multinational corporate is they have one specific concern, which is principal agency. So primarily, principal agency discusses about a relationship between the principal, the one that has the authority, and the agency, the one that received the authority. In the context of a company, the principal is primarily the shareholders, and agency is the managers, the C level, sorry, the corporate C level, the business managers, middle managers. The idea of principal agency conflict is primarily that um, a business manager might not act as what shareholder expected, mainly to maximize shareholder value. In real life context, we see this when a CEO is trying to expand and acquire other company in another market. Primarily, they're driven not by the motivation of maximizing shareholder value, but uh, by doing so, they may attain higher compensation because then the market will be optimistic about the company and later on will drive the share price. On the second matter, um, corporate finance concerns with some corporate markets, including the product market and the subsidiary structure and the financial market. Also, when expanding beyond your host country, there are several associated risks. In this presentation, I will mention about three risks. The first one is political risk, how government may interfere your business in another country. We see this nowadays, specifically concerning about the relationship between Russia and Ukraine, which affect global supply chain. So there's a disruption, and this will, of course, affect some majority of businesses as well. The second is currency risk. So how volatile the currency is, whether the uh, and this is will be driven by several factors that we're going to discuss later. And the third is cultural risk. So when a multinational corporation expand their operations across the country, the product served, the product offered should match the cultural behavior of people. So let's say if you want to expand in if your product is Indonesian food and you want to expand your uh, product and operations to United States, you have to make sure that the taste should be similar and based on what US people are get used to. So to summarize, international finance specifically trying to understand how these multinational corporations behave and operate in beyond their host countries. The second is we're going to take a look on specifically currency exchange. There are five things that I would like to discuss in this presentation. So we're going to better understand the key drivers behind currency exchange rate, the transaction type, and then trade strategy, forecasting, and the some market framework as well. So the first one, we're going to discuss what is the key driver of a currency rate. Primarily, there are three key drivers. The first one is the demand and supply of goods uh, of foreign and domestic market. So this will include goods and services. And the second is demand and supply of securities in foreign and domestic market. And the third is the risk perception, how the market perceive uh, the associated risk. So in the demand of supply, sorry, and of in the demand and supply of foreign and domestic, it is driven by three key factors. The first one is relative inflation rate. The second one is relative income, and the third one is the government restriction on goods and services. On demand and supply of securities in foreign and domestic side, it is driven by two things. The first one is relative interest rates, and the second one is government restriction on capital flow. The second, we're going to discuss about transaction type and trade strategy. So primarily, how should an investor or a firm trade in international financial market? So there are two transaction type. The first one is future. The second one is forward. Primarily, both transaction is a contract that tie one and another party to trade within a specific price and in a certain time. And when we're talking about trade strategy, there are two trade strategy. So the first one is speculation, and the second one is arbitrage. Arbitrage is more rigorous and it's more capital intensive compared to speculation, where you only primarily relies on news and odds. In arbitrage itself, there are three strategies. You have locational strategy, triangular strategy, and covered interest arbitrage strategy. On the last group, we will discuss about two things. First one is forecasting, and the third one is market framework. When in the first one, when forecasting currency exchange rate, usually there are several methods. In this presentation, I will discuss four methods. The first one is technical forecasting, in which you rely on pattern of technical data. So this can be the the volume of transaction, or this can be based on average of closing price, daily closing price. The second is the fundamental forecasting, in which you rely into more fundamental aspect of the currency. So we're talking about economic growth, and we're talking about business cycle. And the third one is market based, in which you primarily relied on market indicators. And the last one is mixed. So primarily you are combining several methods all together to better get more valid and accurate result. And the last one, we're going to talk about purchasing power parity. So mainly in general, purchasing power parity tries to evaluate price of certain specific goods in different country. And this way we can understand how specific country economy may perform in terms of productivity and economic growth. In general, to summarize, international finance focuses on how these multinational corporations interact in terms of monetary interactions, and this will help us to better understand how we can expand our companies in the future. That's all from my side. If you have like any questions, feel free to reach me out via my email here, victor.reyno@ipmi.ac.it.